The Wall Street crash of 1929, the mother of all crashes, also known as the Great Crash, was a major U.S. stock market crash that occurred in October 1929. The crash, which followed the London Stock Exchange crash of September of the same year, signaled but did not necessarily cause, at least directly, the beginning of the Great Depression, involving the failure of 4,000 banks and the loss of employment for one-quarter of the U.S. workforce. The effects of the disruption of the global financial system and the subsequent meltdown of the American economy were soon felt throughout Europe, with devastating economic and political consequences. The crash started on October 24, to be remembered thereafter as Black Thursday, when some companies posted disappointing results, and many investors started to feel this would be a good time to cash in on their profits. Share prices began to fall, and panic selling caused prices to fall sharply. As panic set in, the market dropped by 11%, although panicking investors took some encouragement by a surge of buying at the end of the day. In fact, by the closing of the trading day session of Thursday, the 24th of October, stocks had recovered about a third of their losses. Moreover, investment companies and leading bankers attempted to stabilize the market by buying up of stocks and producing therefore a moderating rally on Friday. But on Monday morning, October the 28th, the slide returned, and the market went into free fall, closing at minus 13%. Well, Black Monday was followed by Black Tuesday on the 29th of October, that is, in which stock prices collapsed by a further 12%. As traders and investors began to panic, they started calling their brokers and caused phone lines to jam. Communication lines broke down and rumors started to spread, with investors unsure about how much they were actually losing because they couldn't get the information in real time. False rumors that investors were jumping out of skyscrapers further fueled the panic. At that point, banks, anxious to protect their own assets, demanded repayment for the loans they had provided to individual investors. And so did the stockbrokers, who called in margins and sold the stocks of investors who couldn't immediately repay the 80 or 90% they had borrowed. These forced margin calls and distressed sales of stocks prompted a further plunge in prices. So the stock market was in a downward spiral that would only bottom out in June 1932, at which point companies listed on the New York Stock Exchange had lost 90% of their market value. To place 1929 in context, we should start by saying that it came at the end of the so-called Roaring Twenties decade, which was a period of exuberant and substantial economic growth. Indeed, between 1922 and 1929, US gross national product grew at an annual rate of 4.7%. Industrial production grew at 3.1% per annum, and unemployment was constantly below 4%. The US economy boomed around automobiles, electrical appliances, and chemicals. The market had been on a 9-year run that saw the main stock market index, the Dow Jones Industrial Average, increase in value tenfold, peaking on the 3rd of September. On the 25th of March 1929, the stock market corrected, falling 10% from its 52-week high. Yet, as stocks hit new highs in the summer months that followed, investors ignored gloomy predictions and even appeared to be right when the Dow Jones hit a record high on September the 3rd, up 27% from the previous year. A brief downturn in the market on the 18th of September raised eyebrows among investors, but did little to stem the tide of investment. Au contraire, many investors regarded the September price fall as a healthy correction and buying opportunity. Shortly before the crash, economist Irving Fisher famously proclaimed, "Stock prices have now reached what looks like a permanently high plateau." Contrary to conventional belief, the stock market crash did not directly cause the Great Depression that followed. In fact, only approximately 10% of American households held stock investment at that time, though the stock market crash of 1929 did act to accelerate the global economic collapse, of which it was also a symptom. The Great Depression actually really began when the banks started failing in 1930, and then there were more banks failure in 1931 and 1932. And it is called Great because, and rightly so, because that depression devastated the US economy to a huge extent. By 1933, nearly half of America's banks had failed. Wages fell 42% as unemployment rose to 25%. And it was estimated at that point that some 34 million Americans had no income at all. Unfortunately, fear of a new speculative fever led the Federal Reserve Board to oppose easier monetary policy after the crash. Hence, the tentative revival of the economy in 1930 had less chances of success. Higher interest rates caused economic activity to slow down in the US, and this monetary tightening triggered recessions in several countries and caused global commerce to contract. The relief and reform measures by the administration of President Roosevelt became more interventionist, and fiscal policy was loosened. But it was too late. The US economy would not fully return around until after 1939, when World War II revitalized American industry. Across the Atlantic, meanwhile, Germany was suffering its second economic calamity in less than a decade. Indeed, already in 1923, the harsh peace terms imposed by the Treaty of Versailles had helped to create the conditions for hyperinflation, when $1 could be exchanged for 4.2 trillion German marks. In 1932, a strict austerity program left more than 40% of Germany's industrial workers unemployed. German economy suffered as the pound fell, and rival British exports became cheaper after Britain abandoned the gold standard in September 1931. Chancellor Bruning's government settled for another round of austerity, but by 1932 his policies were largely discredited, and Adolf Hitler was on course to replace him. By 1929, a sense of economic prosperity had led the industrial companies and agricultural businesses to step up their production. Though with a surplus of iron, steel, and crops, industrial and agricultural sectors were struggling to maintain profits, which reflected itself in slowly sliding stock prices even before October. Other warning signs began to appear but were largely ignored. Car sales and home building all slowed, and consumers were building up personal debts. Now, one factor that drove prices even lower, that would drove prices even lower when the crash came, was that easy credit were extended by the banks to investors. Actually, investors could buy on margin, which meant they paid only a fraction of the stock prices and borrowed the rest from the bank or from a broker. Borrowed money poured into equities markets, and stock markets soared. By August 1929, brokers were routinely lending small investors more than two-thirds of the face value of the stocks they were buying. Ultimately, what caused the 1929 was a classic case of a speculative bubble popping, and the ensuing panic causing a dip in the market to become a full-scale free fall. It was a vicious circle uh, where dropping prices caused massive losses and mass stock sales, which further dropped prices. Beginning on March 15, 1933, continuing through the rest of the 30s, the Dow Jones Index began to slowly regain the ground it had lost. In late 1937, there was a sharp dip in the stock market, but prices held well above the 1932 lows. The Dow Jones would not return to the peak closing of September 3, 1929, until November 23, 1954.